Welcome.
Hello. So I'm going to introduce Roxane real quick to all of you guys. So Roxane Webster is one of my coaching colleagues. I know some of you are coaching with me and some of you are guests from other coaches or just other areas and saw the information about this call. But one of the things, so Roxane, you have a couple of decades experience in real estate, correct?
That's correct.
And in your experience, you have not only been a realtor representing buyers and sellers, you've also been a real estate investor.
That's right.
And you have sold through, with having decades of experience, you've been through many markets and you've seen many incarnations of seller market, buyer market, uptime, downtime, all of it.
That's exactly right.
You know, in this time, Roxane has developed a very deep, keen insight and knowledge into forbearance, mortgages, the different impact that, say, you may be sitting there thinking, well, my market's not going to be impacted by what's happening in the general, populace. And Roxane is going to share a lot of her insight on, and pretty much on an overview basis of what's happening right now in our country with mortgage holders, mortgage process, forbearance, the possible impact it may have on different markets. I believe that she's going to be willing to answer anything, so we'll have a fun, it's an ask me anything type of approach. I know that as a coach, Roxane and I share that mentality. It's an AMA mentality. I am going to turn this over to her. Roxane, I want to thank you up front for sharing your wisdom and knowledge with us today, and take it away.
Excellent. We've got a few more people and we are admitting them all. Excellent. All right. So how many of you are still in markets that feel like the Hunger Games? Right? Same here. I put a house on the market on Friday evening at 4 p.m. for $440,000. And by the next morning at 11 a.m., I had 5 offers in the 470s, right? Complete Hunger Games. And if we listen to Gary, what he has been talking about is that we are right now really in kind of a COVID bubble. I call it the hangover of the previous market. And I think that we've also had some circumstances that combined, right? One circumstance that we had was that when we were all on some version of a lockdown, that further restricted the inventory. So what had already been super tight inventory has been further restricted, not only by the lockdown, but by some people who just don't feel comfortable putting their house on the market and having it open from a health point of view, right? So we've got what was already a super tight inventory situation tighten further. And then we've seen the interest rates dropped to an unbelievable low amount. The interest rates right now, in my assessment, are lower than the cost of money, right? So this has combined to take what was already really, really tight supply and really rabid demand, and has only heightened that imbalance. And that's why I think that we're all still sitting in the Hunger Games, right? What we can't deny, however, is the underlying economic factors that are in play, in spite of the fact that we threw, that's the second big factor, is that we threw $3 trillion into the economy in a matter of a few weeks. $3 trillion. So that $3 trillion showed Paycheck Protection Program, loans to small businesses. It showed money being dumped into people's bank accounts, stimulus monies. We saw unemployment benefits that were increased, a bunch of things done very quickly, $3 trillion worth thrown into the economy. And that has led to people being able to continue spending, right? Continue to pay their bills and so forth. But once those monies stop, then what is the underlying economic situation has to start emerging. Right, and that underlying condition, it tells you the state of our economy when all of us get an unemployment number last week of 10.2 and say, that's great news, right? In what fantasy is a 10% unemployment number great news? It's great news because it was down from whatever it was a few weeks before, 13%. Right, but we're also looking at small business closures all over the country. That's the underlying economic situation, and then of course the unemployment. We've gotten used to that in this country. Our housing crashes, our housing adjustments being tied to lending, right? In the Great Recession, stupid loans combined with idiotic consumer behavior, pulling all their money out of their house, using it as an ATM. Now it's a very different market because most people learned their lessons. We have never completely loosened up the lending situation and gotten back into subprime lending. And by and large, people have been leaving their equity where it was. So now we find ourselves in a situation where there are many, many, many people in this country who are house rich and cash poor, right? So when I take a look at, there are a few other things that have caught my attention recently. This was from an article from Market Watch, which is a lender rag. And I was unaware that 42% of all jumbo loans are given to people who are self-employed. 42% jumbo loans go to people who are self-employed, and right now 12% of those are in forbearance. Right, so I think that we have a big hit that's likely to be coming to the luxury market. Here's a chart that I wanted to share with you from this same industry rag. Let me pull it across. Can everybody see this?
We see it.
Okay, so this is jumbo originations, both for purchases and for refinances in 25 largest metro areas. So you see in 2006, we had 224 billion. I'm just going to talk about the purchase side of this. Right, we had 224 billion in jumbo loans originated in 2006, 172 in 2007. Look at 2008; it dropped to 31%, right? And not 31%, to 31 billion, right? And there it kind of bumped along through 2008, 9, 10, started to recover in 11, 12, but it really has only been, 2015 that we started seeing the recovery in the jumbo market become more robust. Never up to those levels we saw at 224 billion, which I think is probably a good thing because a lot of those 224 billion represented subprime loans, people who had no business getting jumbo loans. So that we've been bumping along in the 150, 125, 117 billion in originated jumbo loans. That speaks to a little bit more conservative lending in that market. And then first quarter of 2020, we saw 20 billion originated. If this market follows the same trajectory, right, from 172 to 31, right? If we see the jumbo market drop out, which we are likely to do, that means that, when we put that together with 42% of these loans being self-employed people, people who are small business owners, we start seeing how the small business failures that we're seeing around the country, which are profound, right? We've already seen, as of a month ago, 22% of all white-owned small businesses had already closed their doors forever, and 42% of black-owned small businesses closed their doors forever. These are profound impacts, and a lot of those are sitting right in the jumbo market as well. So let's dig a little bit into forbearance. Does everybody know what forbearance is?
Let's pretend that there's someone that doesn't. I don't know what it is, Roxane. Tell us.
I will tell you. So forbearance is, we saw this happen almost immediately at the beginning of the oh crap phase of this thing at the beginning of March, when everybody realized this was real and it was going to have impacts, right? That effectively COVID had yanked the electrical cord out of the collective wall of the global economy, all in a matter of a few weeks, right? Which none of us have ever seen or even imagined. And during that period, we saw the CARES Act was passed. And then we also saw other banks and auto loans and credit cards offering people the opportunity to skip payments, right? And the first thing that's important about forbearance is that that is not forgiveness. When somebody skips a few mortgage payments, they still owe those monies to the bank. And I immediately, having done hundreds of short sales and helped people do loan modifications during the Great Recession, I saw that this was going to be an enormous problem. And the reason I said it was going to be an enormous problem is because we didn't know what the repayment terms were going to be. Right? So if you skip your payment for 3 months, 4 months, they allow you to skip those payments. How are you going to repay those monies? Right? And I'm going to pull up a little flow chart, mind map. When I create things like this, my team calls me the Unabomber. Let me pull up a nice little Unabomber here.
I thought they called you that.
Pardon?
I thought they called you that when your hair went crazy.
They do that too. But this, look at that. How's that for Unabomber material right there? So this is a mind map that I put together to discuss forbearance. And I will make this a little bit bigger in a moment, but I wanted you to see the big picture here, because you see all these different decision threads throughout this transaction. The 3 outcomes that are in green are the only outcomes that do not include destroyed credit and potential financial ruin, right? So when we start discussing a forbearance with people, we are in a position to be the tour guide of this experience for them. You're going to see as we dig into this thing that in a lot of cases, we're looking at things that are way above our pay grade to be talking about: legal advice, bankruptcy, financial advice, tax advice, financial planning advice. Those are way above our pay grade. But by the time people are in trouble, they're ashamed of the situation that they're in, so they won't talk to you unless you've already created a financial intimacy with them around these topics, and you're the person who's the tour guide, right? That they say, if we establish this properly from the beginning, we can know where these break points are, not because we're about to give them legal advice, but because we know that they need legal advice at that point. And by us being able to get people into that break point and us being the conduit from which they can get all this advice, it keeps us right at the center of their decision-making process as they decide on what their courses of action are, right? This gives us a really profound possibility to impact people's lives and to consume market share. So when I look at this, I'm going to pull us over. I think when I talk about the repayment terms and why I'm so spooked about those, I am seeing 4 models that are coming out of forbearance repayments. One is that they just defer the payments and tack them to the end of the loan. Completely civilized. We can do that all day long, and as long as somebody's able to pick up and resume their mortgage payments, they're not going to have a really detrimental outcome to this thing. The other thing that we're seeing is we'll see those deferred payments spread out over some period of time. So they may have slightly increased payments over the course of a few years, but that's usually manageable, right? The third option that we're seeing is that they are being asked to repay the entire amount at the end of the forbearance period. Right, so somebody might be $15,000 behind on their mortgage. They're being asked to repay that all at once in addition to this month's mortgage payment. And the other one that even spooks me more than the previous one is the, well, stop paying now and we'll figure it out later option with your mortgage, right? The numbers are pretty big. The last time I checked, we had 3.9 million in forbearance in the United States. And there's a misconception that the CARES Act is not going to require you to make a total repayment all at once. If you actually read it, what it says is that while repaying all those back payments at once is an option, we understand that that may not be feasible for some people. So that we will explore other options with you, including loan modification, loan deferment agreements, extending the forbearance. But there's no guarantees in there whatsoever that they're going to do the civilized route, which is tacking those to the end of the term. And even though, and the CARES Act only targets, only applies to government-backed loans, right? So any things that aren't Fannie, Freddie, FHA, VA are not covered by the CARES Act. And even if the CARES Act is saying, no, we won't require it all at once, there's nothing that guarantees that in the CARES Act. And the idea that the banks are going to pick up the phone and have negotiations with people, 3.9 people in the span of a few months, is a fantasy. Is there anybody here who was working during 2007, 8, 9? Right? And Bridget, did you have anybody in your any of your clients attempt to do loan modifications?
Yes. Yeah.
What was the outcome of that?
Dicey.
Right.
Very, and it was, it was no easy walk in the park.
No. When you think about the bank's position, right, if they are going to allow you to enter into an agreement to repay these back payments, they're going to want to know that you can in fact make these past payments. So what they're going to want to do is qualify you, right? Like they did with loan modifications. So when we look at qualifying somebody for an arrangement with the bank, qualification is going to go through the same exact process that you do to get a loan approved when you're purchasing a property or refinancing. So they're going to want to see your tax returns. They're going to want to see your bank statements, your W-2s, at just a moment where everybody, the whole world is flocking to refinances because of these low interest rates. Right? So the idea that these banks have even the capacity, let alone the wherewithal, even if they had the willingness to fully qualify people onto these, onto some repayment plan, just doesn't seem feasible to me.
No.
Yeah, I just don't see how it's happening. If we think that's going to happen, you guys can come visit me in Colorado and smoke some hope dope. So,
can you do me a favor, Roxane? Can you make your screen full?
Yeah, I can.
Thank you.
Is that better?
Yeah.
There we go. And then let me make it a little bit bigger. There we go. So
the volume of the numbers is when you really think that part through, that's where it gets a little bit like where you stop and go, where is this going?
Right, especially since, I mean, unlike 2007 and 8, where everybody was upside down, right? And that led to this spiral of people either doing short sales or bank-owned properties, which every time you had another round, if today the market value, average market value is $500,000, and then a bunch of bank-owned properties come on the market, well, they don't want to be in the business of holding on to real estate. So what they do is they price it below the market so that they get a fast sale. Same thing we do if we want a fast sale. And if you've got 5 regular market properties at 500 and you've got one priced beneath it for 480, that 481 isn't going to determine a new price point. But if those positions are reversed and you've only got one at 500 and you've got 5 at 480, 480 becomes the new price of the market. And then if they want to sell those houses quickly, the banks price them at 460. And if you've got enough of them at 460, that becomes the new price set, right? So when we had houses that were upside down and people couldn't afford to sell them for equity, it caused this really rapid spiral in values that went downward. This time we have equity. Most homeowners are in an equity position unless they bought in the past, year or 18 months in most of our marketplaces. And the banks have even less incentive to work with people on these loan modifications and payment plans, because they take a look at it and say, you're sitting on you're sitting on $50,000, $60,000 in equity, and just sell it, right? You should just sell it. So I foresee that as these forbearance plans start coming due, we're likely to see a large number of listings come to the market as a result of this. And that's going to start correcting this balance, right? Where this imbalance that we've got in the market, as we have more listings coming on the market, buyers have more choices. Since they've got more choices, they're not writing offers that are $60,000 above list price. As we swing from that 1 month of inventory, most of us are getting to 6 months of inventory. That could happen very quickly, and 6 months is a balanced market. If we get to 12 months, we're clearly in the Hunger Games in the other direction, right? And as we see, there may well be a similar dynamic that if all of a sudden right now, everything flies off the shelves, right? But if we get into a position where there are in any given neighborhood 10 properties on the market that are in a position where they may go into default on their loan while they're trying to figure out with the bank a forbearance repayment plan, they're going to do the same thing the banks did. They're going to drop their price below the competition so that they get a fast sale. And then once enough people do that, that becomes the new price point, right? So we're going to see a similar dynamic, only it's going to be coming from the sellers, not from the banks. That's why I believe we're going to see probably a profound loss in values over the course of the next 36 months. That's my crystal ball.
Now, Roxane, do you believe that, because I've heard you say that, but you and I haven't discussed it person to person yet. So do you think that that decrease is going to start right now, or do you believe that decrease is going to start in, say, 6 to 9 months when some of these CARES Act deferment protections are ending their lifespan? That's kind of when I think it's going to be.
Yeah. This gets us into crystal ball period, right?
Yeah.
I think that
right here,
right? I've got my here my crystal ball. Rub the belly. I think a lot of it is going to be determined by what happens in Congress in the next few weeks. If Congress infuses another $1 trillion, $2 trillion, $3 trillion into the economy, that's going to prop this up for another period of time. You look at what they did in March, that props things up until still now, right? Between that and the lower interest rates. So I think that I think we're already starting to see the beginning of it, right? But what we're seeing the beginning of is the people who are unemployed, because those people are not going to be able to get a forbearance repayment plan. Why would the banks say, give you a repayment plan when you have no means of paying it, right? So those people, and that's going to be largely the non-secondary, non-government backed, those we're going to already start seeing filtering into the market. However, they're in the Hunger Games, right? So they may well be able to scoot out of here with really coming out smelling rosier than they would a year from now. I'm kind of with you. I think we start seeing the profound effects of this happening 9 to 12 months from now.
That's what I think. And one of the reasons, just to interrupt for 1 minute, Roxane, one of the reasons I invited Roxane was really wanting her to do this call is I feel I had heard her, the description that, let's say the last 8 minutes of what she just said, the way that she described chasing down the market which I know that you're all familiar with a seller that's chasing down the market. The way that she described it is excellent. And any of you who are on this call, or if you're listening to the recording, I would go back, and I plan on myself re-listening to how she described that over and over. When she gave the example of the equity sellers and the one bank-owned property versus 5 bank-owned property and 1 equity seller, so to speak. That language is powerful. And if you incorporate that into the way that you have pricing discussions with your clients, I believe that's going to be very impactful. And the other thing is this chart that you can go through, which I'm assuming you're going to get back to that.
Absolutely.
And so that you can show people that even if they're feeling as if they're insulated from what's happening, it could possibly still have an impact on them should they choose to sell. And this backs up, in my opinion, that if you're thinking about selling within the next year, it makes more sense to sell now than 12 months from now. So
I think that if you're selling within the next 3 to 5 years, it makes more sense to sell now.
Agreed. So yes, yes, I turn it back over to you.
These are complicated conversations that we need to be having with people. And we're also having a version of this with our buyers, right? Because if I think that there's going to be a profound loss in values, does it make sense ethically for me to be getting my buyers into a home purchase? And that then becomes the same discussion flipped backward. Well, do you plan on staying in this property for the next 3 to 5 years? Because if you are planning to stay in this property for the next 3 to 5 years, what you're buying right now is not a purchase price. What you're buying is an interest rate that we will never see again. Right? And even if your house, if you buy it, and I know full well you buying it today at $450, it may drop to $375 in value. That's just paper value. And all the time you're chugging along, that value will always rebound. It's just when will it rebound? And if you feel very stable in your employment situation, you just don't look at it and go along clocking your 2.9% interest rate payments. The value of it will come back up, but you'll never see the opportunity to have such purchase power as you do right now. Even if that house lost value, $50,000 in value, if the interest rates were an additional point or two higher than they are right now, that value would still equal the same exact payment right now. So these are more complicated conversations with our buyers that we have to have around this as well, so that they're not feeling like, oh, you sold me this house when you knew that the values were going to drop. Well, address it right up front. Hey, you're going to buy this house, it's going to lose value over the next few years, but you're never going to see a 2.75 interest rate again, and your purchase power based upon that. So these are more complicated conversations than we're used to having.
Right. And the reality is, anyone on this call, we know right now, the next batch of real estate created millionaires will be created right now and in the next 18 months. And it will be for exactly those people that are willing to take the action, understand the value of that interest rate, and they acquire properties and are able.
That's exactly right. That's exactly right. So moving along in this, when we talk about preparing for repayment, this first green option that gets us to a good outcome. And this is the first time that we need to have people, we need to discuss having people in our stable, the financial planners, the CPAs, the bankruptcy attorneys, right? If somebody is in one of these type of deferment plans, they need to be preparing for how they're going to repay it. And this first side that I've got here are for people who are employed. Right, so somebody who's employed may have the option, if they are not in a forbearance yet, they could always refinance their home, put some cash out, throw that in the banks. They've got some reserves. They've got the wherewithal to ride this thing out however long it lasts. If they don't end up doing that and they actually are now in a forbearance agreement, they're either going to have to pull that from savings to get current on it, assuming that we've got a bad case where they're being asked to repay the entire amount at once. And I think that when we're dealing with the banks, we should always assume the worst case scenario here, and everything back from that is going to be a better outcome. I think there are 2 golden rules to the bank. Rule number one is the bank never loses. And rule number two is that the bank always wins. Those are the first two laws of financial nature in this world, right? So let's say somebody doesn't have the reserves or the savings to repay a $15,000 bill they've just gotten. They may decide they're going to pull it from their retirement funds. Well, you're going to, of course, have somebody, this is one of those points where you knowing a piece of data doesn't mean you're going to advise people on it, right? I want to be very clear on that. But for example, if somebody's 40 years old and takes $15,000 out of a 401k, that $15,000 would typically double every 8 to 10 years. Right? So by the time they're 70 years old, that $15,000 they pulled out of their retirement funds might well have turned into $500,000 in retirement funds. Right? So for the sake of keeping one property, that if instead they sold it today at the top price that they're going to see for the next 3 to 5 years, they banked that money, maybe they rented or downsized, right? Their whole financial position would be profoundly different. And by the time they retire, they haven't put a $500,000 ding in their retirement plans because they made a panic decision right now to pull it out of their 401ks. So we want to know that this is an inflection point when we're talking with people about this, that when they're making that plan for what's the worst case scenario repayment, before we actually get to that negotiation, please talk to your financial planner to see whether or not this is a viable option and what are the long-term ramifications of that decision. This is the first time that somebody may actually decide that selling their house now, preserving their credit, banking the proceeds, downsizing or renting, and being able to buy back into the market at lower prices. There are very few people who are in their home who really want to do this. And if they're thinking clearly and you're in these conversations with them, they'll come to this decision on their own. I have been listing houses this week and last week, so people that I had this conversation with in March. Right? I had them go talk to a financial planner, do this, try that, boom, boom. All of a sudden, Roxane, I think it's time for me to sell. Boom. They come to that decision on their own because we're already in this financially intimate conversation with them. So it gets uglier on the other side when we talk about people who are unemployed. Because if they're in forbearance, now when it comes time to create a plan with the bank is not likely to give them a repayment plan because they don't have the income to continue making those payments. So this is when we start adding a few more categories to the repayment plan. Do they have a personal loan? Do they have a brother, a mother that they can borrow the 15 grand from? Again, the retirement funds, are they going to pull it out of retirement funds? Does that make sense? What are they going to do after they've come current? Do they have the wherewithal to continue paying that mortgage if they're unemployed, right? It may be that we look at a bankruptcy option. Again, that's not a conversation for us, but we know if somebody's unemployed, their house is threatened, and the bank is not going to work with them, there may be some bankruptcy options that could keep them in that house if they could continue paying the mortgage. It's just that past amount that's mucking them up.
Roxane?
Yes.
Can I interrupt for 1 minute?
Yeah.
One thing on the personal loan front, if they are unemployed and they believe they will be unemployed or underemployed for any length of time, one of the problems with a personal loan is you get $15,000 from Aunt Joan. You put that into your house to get current, which really doesn't impact principal because it's all, fees.
Back fees, yeah.
And then 3 months from then or 4 months from then, if you're in that same position, then you may be in a position where you could still lose the house. And then you also lost that $15,000 from Aunt Joan. I know any of us that sold through the recession time, I'm sure we had people that were in that spot.
Absolutely.
So it's, could they do it? Yes, but that's another one, as you mentioned with the retirement, be really careful with that, because that is a Band-Aid on a bleeding ulcer. So anyway, I just wanted to throw that
I
in
love
there.
that. It's a Band-Aid on the bleeding ulcer. I completely agree with you, right? Versus you take that same person, if they're unemployed, right, and they're sitting on $200,000 in equity, right? That person could sell today. They could put 200 grand in the bank. They could pay rental. They could pay all their housing expenses for a year up front and still have 150 grand, 175 grand sitting in the bank that helps hold them out until they're reemployed again. It preserves their credit and they still have a down payment on a replacement house at a price that's likely to be 10, 15, 20, 30% lower than what they had today. They may well be in a better position and they can shore up their whole financial position and not have destroyed credit, even though they've got this unemployment event happening. Right? And you help somebody come up with a solution like that, right? Whereas I did that, right? I remember sitting in a hot tub with my husband in March and we were talking about food chain disruptions. And he said, should we plant a garden? And I said, baby, we should sell the house. Right? It's not going to be worth more than it is at this moment in time for 3 to 5 years. We moved into a rental. We got a big chunk of money sitting in the bank. We paid 6 months of rent up front, and we're going to buy back into this market into house hack. We'll buy into a fourplex and still have the money to buy another 2 or 3 of them. We're going to set our retirement in one play, 36 months, one play, right? And if you can be having those conversations into your database with people, that has a profound impact. We listen to Gary, we know this thing is bad and it's going to get worse, a lot worse, right? Unless they come up with some vaccine in the next few months. And even if they do come up with a vaccine in the next few months, we have pulled, just in Colorado alone, Department of Labor is estimating that just based upon the lockdown alone and the ensuing job losses, Colorado is going to be losing a net $9+ billion in personal income in the next year. Right? Think about that. That's profound impact. Right? So us being able to take somebody who's in a position where they've lost their business, they've lost their job, they're out there competing with 10% of the country for what employment there is out there. If you all of a sudden offer that person an option, a way of completely solidifying the next year or two financially, still having money in the bank, still being able to provide for their family, even if they don't have a job, preserving their credit and still being able to buy back into the market at a reduced rate, you just altered their trajectory forever. That move maybe makes the difference between their kid being able to go to college or not, them being able to retire at a reasonable time or not. These are profound impacts that we can have by knowing how to have these conversations, being prepared to have them, right? If somebody's unemployed and they don't have any equity, this pulls us in potentially to short sell questions, to bank-owned questions. And there's some great materials being put out for maps, by maps on this. So I was thinking maybe we could, rather than spending too much more time on this, now get into how we can actually use this in our databases and have these conversations.
That's the path I'd like to go down. And I believe with my clients, because I do, I coach a high percentage of luxury agents,
Yeah.
And above average sales price, tight market agents. So that's the path I'd like to go down, if that's all right with everyone else.
Does that sound good to everybody? Are there any questions on what we've gone over here before we shift gears?
I have one.
Yes.
Could you restate, you said that in jumbo loans, 42% were obtained by people that are self-employed.
That's right.
And then I did not write down in my notes the number of those that are in forbearance.
12%.
12%.
Of all of jumbo loans.
So that's 12% of all jumbo loans.
Not just that 42%.
Okay, that's what I wanted to clarify. Okay.
Yeah. Yeah. So, and it makes perfect sense, right? This is also a demographic that is more likely to have maybe some savings, right? They may be able to hold out longer.
Absolutely.
They
usually have more options.
That's right. They usually have more options, but the option of refinancing is off the books, right? No way for you to refinance if you're unemployed, if you don't have any income. And my experience in luxury is that many people in the luxury arena live paycheck to paycheck too. They're just bigger paychecks, right? Bigger lifestyle shifts, right? Yet that's also a very, these conversations, people who are in the luxury market, just almost by definition, tend to be more financially savvy, right? The financial nimwits typically don't acquire a lot of wealth, right? They do all the things they spend before they save, et cetera, et cetera. So if you're able to have these high level financial conversations with them, they make sense, right? People in the jumbo market absolutely know what happened to the jumbo market in the Great Recession. Right. So getting into conversations with these people about either, I had a conversation with a 1.5 million guy that I've been talking to for a long time, an expired listing. And when I started talking about this, a few minutes in, he asked me if I had studied economics in college. And I said, no, sir, I studied music in college. I said, but I've been doing real estate for 25 years and I'm a student of the market. And he says, so you're telling me I should sell now? And I said, no, not necessarily. I'm telling you, you should either sell now or you should prepare to go to ground for 3 to 5 years. That's your decision right now. If you want out of the market right now, you're not likely to get more than you will at this moment for the next 3 to 5 years. And especially if we see the jumbo market, because again, when we take a look at that supply and demand, we always see longer marketing times on luxury because they're more specific houses and there's a smaller buyer base. Well, if you take that smaller buyer base and cut the feet out of it, completely eliminate their financing, then all of a sudden the luxury market buyer base is completely constricted to those who can purchase all cash in the $1, $2, $3 million range.
Right. Which, I mean, that's the flip side of this. And I actually coach a lot of investors as well, is that in everything that you're discussing, there's actually a huge opportunity, huge opportunity. So, again, we keep going, but yeah, it's a big opportunity.
One of the things that I've been doing, given that opportunity, and this is something that I would say is an action step for anybody who's got investors in their database, right, is that you should be on the phone with them offering to do a portfolio review. And reviewing with them, do they have any non-performing or low-performing assets? Are they overextended? If they're overextended and they've got a non-performing asset, let's say that maybe it makes sense for them to sell that non-performing asset at, again, the top of the market and 1031 exchange those funds into one of the existing properties so that they reduce their payments on those. You solidify the stability of those assets that are performing, right? They love that conversation. Maybe the conversation is, maybe they're not over levered on those properties, but again, they've got, now the conversation is how do we create liquidity so that you can take advantage of this next market that's coming? Do we have any low performing assets? Let's liquidate them. Even if you don't 1031 exchange, it may well be that they are willing to take the tax hit on that for the sake of having that liquidity, knowing what that liquidity will allow them to do for their portfolio. right? So I think having portfolio reviews with all of your investors tells you, A, if they're in trouble, because if they're in trouble, they may need to be liquefying some or all of those properties right now. But in most cases, even if they're in trouble, liquefying one that's got a lot of equity may solve their problem on the other ones. Or liquefying that one that's got a lot of equity and low performance so that they've got the liquidity to take advantage of the next market. That's one action step I would be doing into all of our databases. Another action step that we have been doing, we just sent out a hand-addressed mailer to 1,500 past clients. We did it all in 1 week.
Hold on a second. I need to throw up real quick.
Oh my God, yeah. Well, I'm from Detroit originally.
Just when you said that.
I'm from Detroit and I live in Colorado, and every few years I get all misty for the heartland and I decide, oh, I should drive back home to Detroit. And somewhere around Iowa, I say, what on earth was I thinking? And I still have to drive back again. That's kind of what I was thinking once we had hand addressed it, about 400 of these 1,500 envelopes. But I'm already asking myself, how can we lever some of our team members' kids and pay them some money to do this for future mailers? But already, we started mailing those out last Tuesday, and we've already set 3 listing appointments off of them, right? And these letters basically said, we can help. That our experience from the Great Recessions is that people who are unemployed, who are in trouble, have no idea where to go for advice, and they're likely to make mistakes like liquidating their retirement funds or blowing through their savings. And we can discuss options that may give you a better outcome. So if you know of anybody who's struggling, or if you're struggling yourself, call us and we'll have a conversation with you. Right? So I think that there's a sub-market right now that if you were doing marketing into your database with that I can help message, there's opportunity sitting right there. And it's the beginning of planting that seed for the trouble they may be in 6 or 12 months. Yes.
So let's say I'm not an old dog like Roxane and Bridget, and I've only been in real estate for 4 years. I don't have that experience. How do I write the letter, Roxane?
I think that what you do is you find who is the most experienced old dog in your office, right? And you say, hey, if I need to have this conversation with somebody, will you come do it with me?
Yes, I think that's an excellent idea. And also for the letter itself, capitalize on the experience of your brokerage or your market center. If your market center is newer, then capitalize on, as you said, the person, so my point is, regardless of how long you've been selling real estate, if you're listening to this recording or you're on this call, you can still do that letter. And
you absolutely can.
You already have 3 listing appointments and you mailed it last Tuesday?
Tuesday, right? Yeah, already last Tuesday. And it's also a beautiful way for those of us who, self-included, whose database may not have the best data. Well, all of a sudden we're going to get back, 200 or 300 mailers. We're going to know that we've got incorrect data on those. It's and all for the cost of a 50-cent stamp. I'll take it, right? So there are benefits to it. And I think that's such a great point, Bridget. This type of market is a great equalizer amongst agents, right? Granted, obviously, Bridget and I have a really great vocabulary and knowledge of these issues, but none of it is proprietary. None of it is rocket science. If you go set up for yourself Google Alerts, and for those of you who've not done those before, you just go to Google and you Google Alerts, and it's going to set up for you. It's going to allow you to set up, you can pick any topic. You can say forbearance, COVID and the economy. I've got probably 8 or 10 of them. And literally Google will scrub the internet every day for articles that pertain to that topic, and it'll send you an email. Google alert for forbearance, Google alert for CARES Act, Google alert for unemployment in Colorado, right? So I probably get 8 or 10 of these emails a day. I don't read all those articles. I open it up, I scan. Most of them are going to be things that are of no interest to me, but one of them is going to be an article about COVID rates, and I click into that and I read it. Right? You can, with a cup of coffee and a commitment to 15, 20 minutes a day in the morning, reading these Google alerts, you will become 10 times the expert of any of your competitors in a span of 3 months. And most people, when you take a look at your, if you're new to the real estate, you've got a pre-real estate life. So ask yourself what the people in your pre-real estate life, how they would describe your character. People don't care about your experience. They care about your character, because your character will dictate that you're not going to go make it up. You'll go find the answer for them. Right? So having the confidence to have these conversations, you can educate yourself quite easily, quite quickly. Right? Yes, Brad had a question.
Not do that fast. Hey, Roxane, I'm Brad Sima out of San Diego, and I actually came from the down market buying foreclosures and kind of a product of this environment coming up.
Yeah.
And I love the idea of going into our database, asking the questions and trying to find options. And I'm also looking for, we're intensely looking at the triggers that might happen that would normally be notice of defaults that would come out, but right now, because they're not being filed, we're not seeing any of that pent-up noticing happening.
That's right.
Any ideas on timeline or span as to when you see different triggers that will come out of people that are in this position so we can market to the general public?
It's interesting because I think you've absolutely hit on it. We've got, between the foreclosure moratoriums, we're also seeing many states, like in Colorado, they've added a whole extra month to the foreclosure process. You have to be in default for a minimum of 3 months before they're even allowed to start the foreclosure process. So you want to understand what the foreclosure process is for your state. This is for everybody. You want to know how long they need to be in default. So default means they're not making their payment or they're not making their complete payment. And there's usually some period of default before the bank actually officially instigates the commencement of the foreclosure process itself. And a lot of people think of foreclosure as a destination. It is. There's a foreclosure sale, but it's also a process. And each state is going to have a different timeline. In ours, it's 120 days. So you want to bone up on what the foreclosure process is for your state itself, so you can start having these educated conversations. But what Brad is referring to is that the states aren't even filing the commencements of these foreclosures, which are usually of public record, that allows us to go market to those people. We're not seeing those, and I have not found a way to get at delinquencies yet. Right. One of the things that I've been doing is I have been targeting with, there's I'll have to find the name of it, but there's a data company that political candidates use, or campaign managers, where you can drill down on the politics of people, but they've also got, you can drill down on some pretty granular financial data. So what I've been doing right now is searching for people who have high equity and poor credit, and marketing to those folks, or non-owner occupied and poor credit, and marketing to those. I'm doing all of my Facebook ads on these topics, saying, do you need to sell quickly? We have cash buyers, kind of an iBuyer type message. And then I'm targeting those to people who are searching for jobs, you know, on Lead Accelerator, employment. I'm doing nothing to do with real estate, just all of my targeting has to do with employment and job fairs and et cetera, right? So those are going to be the ways that I'm targeting, but your best bet right now is in that database. If you take, Brad, how many Mets do you have in your database?
800 that are solid.
800 solid. So people who know and trust you, They would take your phone call and be appreciative of any help. If we take a look at the national unemployment numbers right now, out of that 800 right now, today, 81 of them are out of work. Right? We should all be thinking that way with our database. 80 people right now. That's your fourth quarter of listings.
And Roxane, what percentage of that number is in a forbearance program right now?
Probably something like 1/3 of them. Yeah, yeah. And they're unemployed. And they're, in most cases, if they bought more than 2 years ago, they are house rich and cash poor. Right? So the kind of conversations that we're having into our database, I'll share this with Bridget, but I'll show you what our scripting is. Close this bad boy. Where are you? I had these all lined up. I'm one of those people who have 73 tabs open. Because it makes me feel more organized. I don't know what it makes me feel. Okay, so let's pull into Drive here.
That's 266 people are probably in some forbearance and haven't.
That's right.
Told you. Yeah, it's a large. Do the math for yourself because it's a big number.
It's a huge number. Do that into your Met database. That's how many people right now, this moment, today, are needing somebody to have a conversation with them, and they don't know who to ask.
Right, or who to trust or confide in.
That's exactly it. And they're ashamed of their situation.
Right.
Right. So this is the script that we have been using. And this is the follow-up script. Now at the end of this week, we're all getting on Vulcan 7, hitting the auto dialer, and we're going to be doing follow-up calls to all those people and having this conversation.
All the people that got your letter?
Pardon?
All the people that got your letter?
Exactly. All the people that got our letter. And the conversation is going to be, hi, this is Roxane Webster with my home team and Keller Williams. We helped you buy, sell your house X number of years ago. I'm reaching out to check up on past clients to see how you're doing in these uncertain times, because I read last week that 32% of Americans did not make their housing payments in July. So I'm calling to check, how are you and your family? Are you okay? Right. And then a follow-up, most people are going to deflect because this is intimate stuff and they're ashamed of their situation. So what I will then follow up with is a really inoffensive question. That question is, are you still working from home or are you back at the office? You notice I'm not asking them if they're unemployed. I'm asking, are you still working from home or are you back at the office? That gives them a safe place to then volunteer if they're out of work or on restricted hours, reduced hours, right? If they are unemployed or underemployed, I go right to the next part of the script. Oh boy, I'm so sorry to hear that. And then I'm really hesitant because I know I'm about to trespass, right? Do you have the wherewithal to hold out until we've gotten to the other side of this thing, right? It's an inoffensive way to, again, get them. Do we have a few more minutes? Because we're pushing right up on our hour here. Unmute, Bridget.
It's fine with me if you guys keep going.
Excellent.
I will step out because I have a coaching client, but you guys keep going. And then guys,
the recording as well.
Questions you have, she's very knowledgeable. Okay. Thank you, Roxane.
You're welcome, Bridget.
I will talk to you later.
It's my pleasure. So, oh boy, I'm so sorry to hear that. Do you have the wherewithal to hold out until we've gotten to the other side of this thing? Right? And they're going to give you whatever answer they're going to give. Now I switch it into the third person. So I'm not talking about them directly. If they say, no, we don't know what we're going to do a month from now, I go right to I'm really concerned that folks have no idea how to even analyze their situation, since none of us have ever faced anything like this before. I can tell you that we have a lot of experience working with folks in financial crisis, and we're reaching out to start conversations about your options because very few of us think clearly under this level of stress. Would it work for me to have a Zoom call with you and experienced agent in my office, so-and-so, Brad, who came up through this market? And I'm sure Brad would be happy to have that conversation with you until you learn how to do it, right? And then you set up the Zoom. Now you've started this conversation. If they deflect, we're fine, everything's good, we haven't been impacted. Again, I switch to that third party. My closing would be, do you know of anybody or anyone who you think would benefit from such a conversation with us to discuss their options? Well, I don't know of anybody who would. Would you benefit from such a conversation? If you have these conversations, like I said, the listings that I'm taking, thank you, Jane. The listings that I'm taking right now are from conversations I had like this 3 months ago, right? So this is about building a distress pipeline, right? Planting the seed on people that these may be options that they should be looking at, and keep in conversation with them to see if things have gotten better, if they've gotten worse. Do they need to talk to an attorney? Do they need to talk to a CPA? Do they need to, is it an investment property? Are there going to be some tax consequences? If they're an investor, can you do a portfolio review with them? These are all conversations that you get to have in a really direct, intimate manner that people are going to welcome. I know it feels really uncomfortable. Brad, when you were coming up, did people, when you were having frank conversations with them, how did they respond to you?
When I first started, or today?
Yeah, when you first started.
So I'm a little unique. So my backstory is I only had 2 clients during that time because we were buying as an investor. So we didn't have many tough conversations other than evictions. Today, we're being very direct about goal setting and planning with buyers, like you talked about before, and telling them that we think the market's going to shift. And we're having a lot of these people actually reach out to us without marketing to them, that we know they're in tough financial situations and they have to do something.
Yep.
And then we're just laying out options. One that we went on Friday was, they really want an investor to come in and buy it. I'm probably just going to buy the house.
Yeah.
So we're seeing when we lay out all the options to someone, we're better than the average agent that goes in and says, well, just list it really low and we'll sell it. We're having the tough conversation saying, well, we can make this really easy. We'll just buy it or put it on the market, or, we can fix it up, so on and so forth. So
excellent. So you're coming to them with options, right? And that's the most important thing. And even though these are financially intimate conversations, they have nowhere to turn for information. It's like if you go Google foreclosure process in Colorado, you're going to get a picture of an old, tired-looking timeline. It's like if you've got had a family member who got a spooky diagnosis of cancer, right? And you're looking at that report, that medical report, and it says this 2-centimeter meningioma, and then you go to Google and you start Googling those various terms. That gives you no information that's of any use to your current specific situation. So us being able to offer an analysis of where they are right now, that they've got some options, and you will acquire the knowledge you need by setting up those Google alerts and by getting on and seeing the foreclosure and short sale class that's being offered through KW, by listening to KW Connect on anybody who did short sales and foreclosures in the Great Recession, and anything you can read about forbearance agreements and the CARES Act and unemployment numbers in your areas, and how do we get to small businesses that have gone out, that have gone under or are going under, right? This is where we need to start getting creative. But the best first place is your database, because people already trust you. And once you give them good advice, they're going to refer you out to other people for more good advice. Anybody have any questions before we wrap this up? I know you guys are living busy lives, so I appreciate you spending some of it with me. How do I position the letter? How do you position to the letter? More. Oh, wait a minute. House rich, cash poor.
I apologize. That was me that said, how do I position the letter? I was on, sorry, that's my dog in the background, making sure you understand he's here.
Excellent.
To me, that is an awkward letter to write.
It's a very awkward letter to write.
Okay.
Right. But it's honest, and if you have it pointed, if there's nothing salesy about it, right? If and again, it pulls directly from that script that I put in there, right? That in fact, let me copy paste that script into the chat so that you guys can grab it.
So we can use that to help us with that whole,
yeah. Said, hey, I'm concerned because I read that 32% of people are in this position. So this is a time for us to take care of one another. If you hear of anyone who's in trouble, could you please reach out to them? This came in a funky format, but you can copy paste it, make it pretty, right?
That's put it in the third person almost, that, if there's somebody we can help, please let us know.
That's exactly it. And we can help them decipher the communications they're getting from the banks. We can help them get legal advice or tax advice that they may really need. We can help.
Roxane, would you be bold and ask, would you just share the letter and we don't have to recreate the wheel?
Because you are here, as long as you don't share it with anyone else, yes. Let's do this.
That's what you get for staying into the end.
That's what you get.
Woohoo!
Let's see. I can help.
Brad, I like it. You took it to the next level.
You sure did, sir.
This has been
That's
amazing.
what you were asking for.
It was exactly what I was asking for. But, hey, can I offer one thought, Roxane? I live in
absolutely.
Boston. And, Boston, we sort of think we're immune to it.
Yeah.
But it's bullshit, and excuse my language. We are all going to see it. And so, when San Diego's seeing it, guess what?
Nobody's immune. And
No.
The reason nobody is immune is because of the underlying economics of this, right? And the shameful, I'm sending you guys a link to the Google Doc. If you can, when you open that up, copy it before you start editing it, that would be awesome. Right? But the underlying economics are the reality. I think that also a real key, especially if you are in more red states, and I don't talk about red or blue with any dog in the fight, but I think that in some of the red states, this is being taken. It isn't that it's being taken less seriously. There's just a higher political charge to COVID, right? So we need, especially in a political year, in a year of elections, be having sub-political conversations on these topics, right? Because statistically that, a third to half of your database is going to be left of center, a third or half of your database is going to be right of center. So if we could be having conversations where we're saying, whatever you think of the cause of this, we have a financial reality here. And that financial reality is that these unemployment numbers are profound, and they are going to have an impact on all of our markets. Yeah. Well, that's all the wisdom I got, gang. Anybody have any other questions?
That was excellent, Roxane.
My pleasure.
This was amazing.
Yeah.
Thank you.
My pleasure. Go out there and get intimate with people. They need your help. You've got an opportunity to consume market share and really impact people's lives.
Thanks so much.
Happy hunting.